Hi guys, this is Anastasiia Hurtova, your favorite Chicago realtor, and today I am here with Scott Schneiderman with CrossCountry Mortgage, and we're talking about all things financing and buying a property.
Anastasiia, thank you again for having me. Always enjoy being here. Let's get into it. I've got answers for all your questions today.
Scotty, I've heard that this year there is a new option for people who are looking to buy a multi-unit, specifically people looking to invest into maybe a 3 or 4 flat property, that it's now easier for them to do it. Can you elaborate?
Yeah, so in this past year, as we saw home affordability basically at an all-time low, and where interest rates were up, supply and inventory is down. They're trying to create right now ways to get people into homes, make it more affordable, get some more movement and volume in the real estate activity world. Fannie Mae's come out with a new program where previously, if you wanted to buy, let's say, a multi-unit property, so call it a 2, 3, 4 unit property. Normally, you'd have to have either 15, 20, 25% as a down payment, even as a primary residence. Well, now they've changed the rules and they've kind of changed the game into where you only need 5% down.
On a regular conventional loan.
On a regular conventional
many
loan.
of my buyers in the past, when they were looking to buy a multi-unit, they would go with an FHA.
Correct. So before, where FHA really was your only low down payment option for a multi-unit. But with FHA, one of the caveats was if you were buying a 3 or 4 unit property, there's a specific test called the self-sufficiency test that you'd have to pass. And there's a whole mathematical formula behind it, but essentially in this higher rate environment, you couldn't pass the test. It was almost impossible to do. So being that, even if you wanted to go FHA, it was almost off the table. So now, with this new 5% down rule, it makes it way more affordable and way easier for somebody who wants to invest in, whether that's doing a house hack and buying a multi-unit property where, let's say you buy a 4 unit, you take 1 unit, rent out the other 3. You can do that. And the other nice thing about this is the units that you're not going to be occupying, the rental income from those units, you can use 75% of those rental incomes and use that to add back to qualify for the loan.
So in other words, if my or the buyer's income is not enough to qualify for a loan, you can use the rental income
Correct.
To qualify.
So let's just say, for example, you're buying a 3 unit. You occupy 1 and you have the other 2 units that you're gonna rent out. And those 2 units, let's say, rent for $2,000 a piece. So that's $4,000. You take 75% of that number, which is $3,000, and you can add that in as income to qualify for the loan. So that way, right, if your client or the buyer doesn't have enough income himself, or maybe he does, but again, he wants to buy something at a higher price point, now maybe you can step that up in value and in purchase price because you get that add back in rental income. So it's a great program for anybody who's looking to get into multi-units and then eventually probably build their real estate portfolio.
One question, what if my buyer wants to just buy a multi-unit as an investment property and not do a house hacking, not occupy one of the units? Can they still use that type of loan, or do they have to go with something else?
They can still go with a regular conventional loan. The difference is if it's truly an investment property and they're not going to be occupying any of the units, then it's likely that you're going to have to put down 20% versus 5%. That's going to be the big difference. And then the other difference there as well is when you buy a primary residence, the rate that you're going to qualify for, that you're going to be offered, will probably have better terms than a rate that you'll get on an investment property.
That makes sense. In order to get the best terms possible and just 5% down payment, they would have to occupy one of the units for how long?
Technically, it's 12 months.
So last year in the high interest rate environment, what really happened, it pushed many buyers from the market because of the rate. The monthly payment just got so expensive. Are there any ways to help the people make home buying more affordable? Because as we know, it's not just about the down payment. There are also closing costs associated with buying a property. So what would you say is available now to someone who's looking to buy their first home?
There's definitely different state grants, federal grants. There are specific grants that my institution, CrossCountry Mortgage, has that can help with either down payment, closing costs. For us, for CrossCountry Mortgage, we have an affiliation with Freddie Mac. We have a program called Borrow Smart. And with the Borrow Smart, the nice thing about that is if you're a first-time home buyer, if you're in the Chicagoland or surrounding areas, and then there's income levels, so you can't exceed certain income levels. But if you're within these ranges, we will give you either $3,000 and or $4,000 towards your closing costs. And the beauty of it more or less is that there's no strings attached, meaning some of these federal grants and state grants out there, they have clawbacks, or where if you refinance within 5 years, you sell the home within 5 years, you have to pay back a prorated share of the grant that they give you. With this, you want to refinance in 6 months, there's no repayment on it. So
free money.
Free money. Santa Claus showing up at your door.
For the programs, the grants that CrossCountry Mortgage is able to offer now, what are the cutoff points in terms of the income?
Right now, if you're under $87,500, we'll give you up to $4,000. And if you're below an income level of $153,200, we'll give you $3,000 towards your closing costs. The other thing I want to mention about this is qualifying income. So sometimes we'll have a client or two borrowers that say, okay, well, one makes $100,000, the other makes $80,000. So I said, okay, well, you combine them, that's $180,000. They exceed the limit. If you can qualify with just one buyer, so if the person that makes $100,000, if their income is sufficient for the loan, we don't have to use the other income. And therefore, you would qualify for the $3,000. So there's ways to set up the file in order to obtain these grants.
This actually came up the other day. It was one of my buyers. They are looking to buy a property. They're married, and they think that both should be on the loan. But this way, their income will be too high to qualify for one of the programs. So does it mean that even if you're married, only one person can have the loan in their name?
You can put both people on the loan. You don't have to use both employments and income. There's no rules, regulations, mandatory terms in form of having to use both employments and income. So if a couple's married, both have jobs, but you only want to use one employment and one income, you can do that, but still keep both people on the loan.
Is there any benefit to maybe having just one person on the loan, even if they're married?
There definitely are. And in terms of more of a long-term plan, meaning that the other person, if they don't go on the loan and or the title of the home, that person can retain their first-time home ownership eligibility. So whether they want to buy another house or something, let's say in a couple of years, what have you down the road, the person that did not go on the loan or did not go on the title of the home, they can still be eligible for these first-time homebuyer programs where if they didn't, they wouldn't have that eligibility.
Let's reverse this a little. What if the couple isn't married, but they want to buy? Can you have both of them on the loan as well?
There's nothing in place that says a couple has to be married, they have to be related. There's no status that you have to be in order to be on the loan together.
I was talking to a client the other day who is looking to buy his first property, just a smaller one-bedroom condo in Chicago. He doesn't make a lot of money, so he's trying to see what are the ways for him to qualify for a loan. I don't want to throw any numbers here, but let's say they want to buy a $300,000 property, but they don't qualify for $300,000. What are their options? Or are they like out of luck?
The best option is always to try and see if you can obtain a cosigner or somebody who can cosign for the loan. So maybe you have a friend or a family member who is willing to go on the loan, lend their information where they'll have sufficient income. You want that person obviously to have good credit, not a lot of debt, but where that person doesn't mind cosigning for the loan and therefore can help obtain the mortgage for that person.
So probably parents is a good example,
Parents
right?
is a great example. I would tell you that's very common. I see it all the time. It lends to the fact that sometimes you might have a client, let's say, that might be self-employed, but because of the way that they do their taxes, they might make a certain income, but after they deduct and expense everything, their bottom line income is far from what their gross revenue is. So in that terms, a lot of time too, they might need a cosigner to help get in the home.
I have a client who was self-employed for a few years, but then recently got a full-time position, W-2 position. They know that because they were self-employed and the way they reported their taxes, they probably need to wait for a couple years to make sure that the taxes are now reflect their full-time W-2 employment before they buy. Is that true, or are there any options for them to buy prior to waiting 2 years?
Big misconception there. You don't have to always have a 2-year history of certain employment levels. For example, your buyer there, they might have been self-employed and they just got this job. Now, if this job is to where it's a salaried position and they've signed an offer letter, so they've signed with their employer an offer letter stating, hey, you're going to get X amount in salary per year, and there's a contract that's signed by both parties. One, you don't need a history of that job. You can be 1 day in and we can use that income to qualify. Not only that, they don't even have to start the job to close on the home. The start date from the employment contract can be 90 days out from closing. So if let's say you sign your contract, you close on a home January 1st, but you're not starting until April 1st. We don't need pay stubs. You don't need to start. We can use the income on the employment contract, and that's what we use to qualify for the loan, and that's okay. And you'll also see this a lot, especially with students that are just graduating. So they've gone to school, they get their degree or their diploma in whatever field, they're starting a job with, whichever company, they've received an employment contract, same thing. We can get them in a home day one. So you don't have to always have this lengthy history behind you.
Wow, that's awesome. So wait, let's repeat this. If you just graduated from university this year, you just got your diploma, and you have an offer letter from an employer stating your yearly salary, you can go and start looking for a home, and you don't need to actually be working or have received any paychecks in order to close.
That's correct.
Another scenario for you. What if a buyer who wants to buy their first property is employed? However, they are employed part-time and they have a couple of jobs that they work part-time. Are they able to qualify for financing?
I see this come up a lot recently, especially if you are part-time and you're working 2 jobs part-time. In order to use both incomes from both jobs, that you have to have a 2-year history of. So if, let's say, you started a job, you're in 10 months, and the other job you're in 10 months, you can't use them. So you've got to have a 2-year history when it comes to that. And then if you're hourly, in order to be full-time, technically from lending standpoints, it doesn't have to be 40 hours, but at least 32 hours a week. So that's kind of the cutoff between what we consider part-time and full-time is 32 hours a week.
Can you explain to me, if a person works, let's say, as a server at a restaurant and they get like a small wage, but then they have tips, what should they do in order to, again, be able to qualify? Do they track their tips somehow? How should they approach the situation to make sure they're in the right place to buy?
It's tough because it's like when you're getting tips or you're a server or bartender or in the the restaurant or entertainment industry and a lot of money's coming in cash wise. One, you've got to claim these tips on your income taxes. And then once they're on your taxes, do you claim it to where you report all the income, or do you start deducting that income in expenses and deductions? And again, kind of what we talked about, you might say I've grossed $100,000 in revenue, but after you write off everything, you claim 20, and we're going to have some problems as far as qualifying. So the nice part about being self-employed or being a server, again, there's a lot of cash that sometimes you don't have to report, you don't have to pay taxes on.
Sometimes get missed.
Correct. But the flip side of that coin is when you go to buy a home and you don't show that income, that's going to have a negative effect.
So would you say that if someone, let's say, is a server at a restaurant industry and they want to buy, should they be planning very much ahead of time? When
you're going to buy, the prior year, when you're doing your taxes, you want to plan ahead and accordingly to say, hey, this year, I'm really going to, report all my tip money or all my income, not write off as much expenses and deductions. Do that 1 year, possibly 2 years, depending on your situation, get into the home, and then from there, be aggressive. Nobody wants to pay taxes. Let's
say a person just wants to buy something in more expensive area, let's say Lincoln Park, single family home, where the prices start from $1 million and up. Does lending work the same way as if they were looking to buy a $400,000 property?
So there's conventional loans and there's jumbo loans. The couple of the main differences are, one, the cutoff point between a conventional loan and a jumbo loan is any loan amount over or under $766,500. So anything below that amount is a conventional loan. And with those loans, they're mainly backed by Fannie Mae and Freddie Mac. With those loans, they allow for lower down payment requirements. So 3 or 5% down. They allow for lower credit score requirements. It's easier sometimes when it comes to the underwriting process, where if you have loan amounts over $766,500, those are considered jumbo loans. The main difference with those are, one, you usually need about 15 to 20% as a down payment versus a lower down payment option. They're stricter when it comes to credit score requirements. So usually you need a minimum of a 680 or 700 at least. And then also when it comes to qualifying ratios, so your debt to income ratios, they're more strict when it comes to those ratios as well. But in terms of the paperwork and the documentation that are needed for both loans, they kind of run off the same gamut in terms of, you've got to establish your income, credit, debt structures. Those things are all pretty much the same. It's just it's a little bit more rigorous and hard. It's harder to, when it comes to jumbo loans, there's some more red tape involved.
Gotcha. So would you say that if a client is looking to buy property that is above the conventional limit, but not to the point where it's going to be too big of a spread. Will it be more beneficial for them to put higher down payment to make sure they reach that limit, to go a little bit below it in order to stay in the conventional area and not go into jumbo?
It's situational dependent. Sometimes just depending, you might want to kind of get to that 766, 500 threshold, because maybe that threshold is 13% as a down payment versus 20%. And or it's to the point where, based on, again, credit score, debt ratios, it might be more advantageous for you to reach that threshold than to just do a jumbo loan. So there's pros and cons to both. And that's where we come in. We read the situation, kind of see what the buyer, what they're thinking or what their, financial goals are, and then we can plan accordingly.
What you should do to prepare to be in the spring market, because spring market, as we know, is the busiest time in Chicago. Things move really fast. Sometimes you see a property and you need to offer it, within the next hour. Sometimes properties come up and get bought even before they're able to host an open house and things like that. So what should a buyer who's looking to buy in the spring market do to put themselves in the best position possible?
First and foremost, you want to make sure that your buyers are speaking with a lender ahead of their search. So whether that's me or whichever other lender they're working with, you want to make sure that they do their due diligence and get pre-approved ahead of time. Usually we'll tell the buyers like, hey, it's good to start planning accordingly about 60 to 90 days out. Do the pre-approval process, figure out your budget, make sure that lender has reviewed your income, credit, assets, everything, so they're ready to go. Because again, what we tend to see sometimes is these buyers, they don't want to go and do that before. And then on Saturdays, you're taking them out. They start scrambling. Best and final offers are due by Sunday morning. And then it becomes a huge...
Saturday, 9 p.m., you get a call. Can I get pre-approval?
I need it by tomorrow morning at 8 a.m. Exactly.
It's a lot of stress on the buyer, on the agent, on the lender.
And that stress does not need to be there if they just kind of follow the plan in place and do this ahead of time. The other thing that they can do, and we do on our end, is you can have a fully underwritten pre-approval. So that's where not only do we get their information all up front, but I actually get their pay stubs, W-2s, tax returns, all the necessary income documents, have it where we have an underwriter review everything ahead of time. So that way, a lot of the times in this competitive market,
that carries a lot of power.
A lot of weight. And when you're in a competitive market, like sometimes speed wins. So you want to make sure that the seller might want a quick close, or you're competing in an all cash offer. So they want to close in 10, 15 days, not 30 or 45 days. So if we do the pre-underwritten pre-approval, we're basically done with the entire loan process, subject to really appraisal, title work, and then if it's a condo approval, but everything else has been signed off on. So it really helps get that process going there. What I was going to say also is, I'm sure you get this all the time from your buyers as well, and that is, hey, I don't want to do a pre-approval right now because my biggest concern is I don't want my credit pulled.
Well, I feel like I talk to a lot of buyers who are in between renting and buying. They see that the inventory is low and they feel like they might not find what they want. So then out of that comes that fear to get pre-approved, because it's gonna, negatively affect their credit, and maybe it's gonna go down, and then they don't buy, and this whole they don't want all of that.
Nice thing about myself and CrossCountry Mortgage is, one, we only do a soft credit pull to start. I do not do a hard credit check literally till we're under contract and we're full steam ahead moving forward with the loan process. So with the soft credit pull, there's no hard hit to their credit. There's no inquiries that show up, no deduction in points to their credit, but we can see all three credit scores. We can see their debt structure, and that allows us to plan accordingly. And the other nice thing about that as well is, if there's issues with the client's credit, or maybe their credit scores come in low, it allows me to help them, to tell them and formulate a blueprint to say, hey, if you pay off this credit card or you pay down this credit card, take care of this account, we can increase your credit score by however many points to get you optimal terms, to get you a better interest rate, or put you in a better position when it comes time to get under contracts.
This is very valuable, because you don't want to be in a situation where you are trying to secure a property and then at the same time trying to repair your credit and figure out how to make it all work. It's a lot of unnecessary stress that you can avoid by just doing your homework and preparing for that ahead of time.
So just setting the proper expectations and timeline is key in this.
This has been super helpful, Scotty. Thank you so much. Thank you for your time. Make sure you reach out to Scotty for all your pre-approval needs.
Anastasia, thank you again for having me. It's always good to catch up. You can reach me at scotty@ccm.com, DM me directly, or just go through you, and I'm sure we'll be in touch.